For day trading the market open, combining supply and demand zones with opening range price action is one of the most effective ways to filter out the noise of the first 15 to 30 minutes. While many traders use basic support and resistance lines, supply and demand focus on the imbalance that caused a massive move, making them ideal for high-conviction trades at the bell. 1. Identifying fresh zones. Before the market opens, you should identify zones on the 15-minute or 1-hour chart. Supply zones. Areas where price dropped aggressively, leaving behind unfilled sell orders. Look for a rally base drop or drop base drop pattern. Demand zones. Areas where price shot upward, leaving unfilled buy orders. Look for a drop base rally or rally base rally. Freshness. A zone is strongest the first time price returns to it. If it has been tested multiple times, the orders are likely exhausted. 2. The opening range confluence. The opening range, OR, typically the high and low of the first 5 or 15 minutes, acts as your tactical trigger. Scenario. Strategy. OR breakout into zone. If price breaks the 5-minute OR high but immediately hits a 15-minute supply zone, do not go long. This is a bull trap. Look for a reversal instead. Zone rejection at open. If price opens directly inside a demand zone and creates a bottoming tail, wick, look for an opening range breakout, ORB, to the upside. The gap and go. If price gaps over a supply zone at the open, that zone often flips and becomes a new demand level, S/R flip. 3. Key metrics for entry. To increase your win rate, look for these specific confluences at the zone. VBP, volume by price. Ensure the zone aligns with a high volume node. Price action signals. Don't just limit order at the zone. Wait for a change of character, choke, on a lower time frame, like the 1 minute, once the zone is hit. The 2.0 risk rule. Since the open is volatile, ensure your supply entry allows for a stop loss just above the zone, targeting at least a 2-to-1 reward to risk ratio toward the next demand area. 4. Implementation tip. If you are coding filters for this, try using a script that highlights the initial balance, IB, the first hour of trading relative to your higher timeframe supply/demand blocks. When the IB high or low touches a HTF higher timeframe zone, the probability of a trend day or a mean reversion day increases significantly. The first 30 to 60 minutes of the trading day, often called the amateur hour by some and the golden hour by professionals, is uniquely powerful for support and resistance, SR trading, because it represents the highest concentration of liquidity and intent. Here is why that morning volume makes SR levels more reliable. 1. Institutional positioning. Large institutions and hedge funds often execute their primary orders at the open to capitalize on the massive liquidity. Unlike the low volume choppiness of midday, morning volume represents true conviction. Significance. When a support level holds on high morning volume, it isn't just retail traders buying. It's a sign that big money is defending that price point. The result. These levels often become the high or low of the entire day. 2. Clearing the overnight orders. The open acts as a pressure release valve for all the news, earnings, and global events that happened while the market was closed. Price discovery. High volume at the open quickly pushes price towards significant supply or demand zones. Validation. If price hits a pre-market resistance level and volume spikes even higher as it fails to break through, it confirms that the sell-side imbalance is massive. This provides a high probability entry for a short position or a mean reversion trade. 3. Increased volatility equals better risk/reward. In low volume environments, price may take hours to reach your profit target. In the morning, velocity. The high volume provides the fuel needed to move price from support to resistance, or vice versa, in minutes. Tight stops. Because the volume is so high, a break of a level is usually decisive. If price breaks a support level on a high volume surge, you know almost immediately if your thesis is wrong, allowing you to exit with a small controlled loss. 4. The opening range anchor. The high and low of the first 5, 15, or 30 minutes, the opening range, create psychological S/R levels that the rest of the market watches. Volume profile. Often, the point of control, the price where the most volume was traded, is established in the first hour. S/R flip. Because so many shares change hands at these morning levels, they often flip roles later in the day. A morning resistance level that was broken on high volume will frequently act as rock-solid support if price returns to it during the lunch lull. Comparison of volume phases. Phase. Volume level. S/R reliability. Typical price action. The open. 9:30 to 10:30 a.m. Ultra high. Highest. Clear trends or sharp reversals at major zones. Midday. 11:30 a.m. to 2 p.m. Low, moderate/low, often fakes out levels or drifts sideways. The chop. The close. 3 o'clock to 4 p.m. High, moderate. Volatility returns, but often driven by rebalancing rather than new trends. Using VWAP, volume weighted average price, alongside supply and demand zones, allows you to see not just where the price is, but who is in control of the trade at that specific location. If supply and demand zones are the map, VWAP is the compass, telling you which way the momentum is actually shifting. 1. Determining who is in control. Direction. VWAP represents the true average price paid for all shares traded during the day. The institutional benchmark. Since institutions often aim to fill orders at or better than VWAP, price relative to this line tells you the bias of the big money. Above VWAP, buyers are in control. They are willing to pay a premium above the average price. The demand is winning. Below VWAP, sellers are in control. They are aggressive enough to push price below the average. The supply is winning. 2. Location. The value trap between S/R lines. When you draw your support and resistance, or supply-demand lines, VWAP acts as the fair value anchor between them. Long setup. Price is sitting on a support-demand line and is above VWAP. This shows that the floor is holding, and buyers are already pushing price back toward the average, or using the average as a launch pad. Short setup. Price is hitting a resistance/supply line and is below VWAP. This suggests the ceiling is firm, and sellers are successfully keeping price in discount territory. 3. The rubber band effect. Mean reversion. VWAP helps you identify when a move toward a support or resistance line is overextended. Overbought. If price is at a resistance line and is significantly far away from VWAP, extended to the upside, the elastic is stretched. High volume here often leads to a sharp snapback toward VWAP. Oversold. If price is at a support line and deep below VWAP, the location is ideal for a mean reversion trade back up to the average. 4. Confluence with the opening range. Combining these tools creates a high conviction checklist for the morning. Observation. Signal. Logic. Price greater than VWAP plus. Break of res. Strong bullish. High volume is confirming a breakout. Buyers are paying up. Price less than VWAP plus. Test of sup. Strong bearish. Sellers are heavy. The support line is likely to fail. Price crosses VWAP inside a zone. Trend change. This is a change of character. The who in control has just flipped. Tactical tip. The VWAP pullback. The most reliable trade often happens when price breaks out of a morning supply-demand zone, runs for a bit, and then pulls back to touch VWAP. If VWAP holds as support, while price is still above your original breakout line, you have a confirmed trend with institutional backing.